The American empire is entering its final chapter. Gold at $18,000. Bonds uninvestable. The dollar dying. Charles Gave has managed money for over 5 decades. And right now, he's telling you exactly where to run. This is the most important financial warning of the decade. Markets are near all-time highs, but the cracks are everywhere. The Magnificent Seven are distorting everything you think you know. You think you're buying a diversified portfolio. You're not. China built an energy revolution the West completely missed. Coal to gas conversion. 1.5 million barrels of oil per day equivalent. China successfully tested thorium nuclear reactors. This is a bombshell. Electricity in China's largest industrial city? Essentially free. Meanwhile, European electricity prices keep climbing. Germany Energy Cost Index, 6. United States, 3. China, 1. If the economy is just transformed energy, we're in serious trouble. France shut down its Superphénix reactor in 1999. Huge mistake. Since 1999, not one French engineer class has chosen nuclear. EDF is reportedly calling retirees back. Nobody else left. China's Politburo, packed with engineers. France's government, lawyers. Gold hit $4,000, and it could go to $18,000. 1 gram of gold is always worth 1 gram of gold. Every currency on Earth is losing value against gold. The 10-year yield would need to hit 5.5% to stop gold. Currently at 4.1%, still a long way from stopping the gold rally. If yields hit 5.5%, the US budget absolutely explodes. The US holds 8,100 tons of gold in reserve. If the dollar collapses, foreign holders could dump $8 trillion in US debt. Washington could revalue gold from $4,000 to $18,000 per ounce. That would cover the entire external US debt, every penny. So the answer to where gold goes? $18,000. Gave declared Western bond markets officially uninvestable. France is borrowing just to pay interest on existing debt. VAT receipts are down €10 billion. Consumers have stopped buying. On Paris's wealthy Avenue Victor Hugo, every other store is shuttered. No country in history has ever fixed its finances by raising taxes. The only path forward? Brutal spending cuts. Every single time. Argentina's Milei slashed from 32 ministries down to 7. France? 34 ministries. Over 1,000 advisory councils. Those councils cost €30 billion per year. One fights noise pollution. The 60/40 portfolio? It's a relic of a bygone era. 60/40 only works during disinflationary periods. Those are over. In the 1970s, a 60/40 investor lost 40% of their capital in real terms. But 60% stocks and 40% gold? They came out like a god. Chinese government bonds went from 5% yields to 1.3%. That delivered 25% capital gains for bondholders. Western bonds lost 25% in the same period, a 50-point spread. Now Gave is eyeing Brazil with 6% excess yields. And Indonesia, expecting convergence toward Chinese interest rates. Beijing is organizing an entire Asian monetary zone. We're witnessing the most significant geopolitical realignment in 500 years. Maritime empires are dying. Sea power is losing to land power. Moscow, Beijing, and Delhi forming a land-based power triumvirate. The dollar's monopoly on oil trade is officially over. Countries can now buy energy in their own currencies. $5 trillion in dollar reserves sitting in foreign banks? Now useless. Russia, cut off from Europe, didn't collapse. It built new corridors. Siberian resources now reach India and Southeast Asia by land. For the first time in history, no ocean crossing needed. The result? An Asian economic boom of unimaginable proportions. In 15 years, the financial capital of the world will be Hong Kong. Let's go deeper, because understanding exactly why this is happening and what to do about it could be the most important financial education of your life. Charles Gave runs Gavekal Research. When he talks, the world's biggest institutions stop and listen. His track record spans 50 years of calling macro turns that most analysts completely missed. After Trump's election in late 2024, Markets surged on optimism. But Gave saw something different, a wave masking structural rot underneath. The fundamentals hadn't changed. They'd worsened. Gave had recommended a 15% allocation to energy ETFs. The MSCI World Energy Index underperformed. He admits he was too early. But being early and being wrong are two completely different things. The S&P 500 Fossil Energy Subindex is actually up 11% and outperforms the S&P 500 Equal Weight by 2%. The issue isn't energy. The issue is the index itself being distorted by a handful of mega-cap tech stocks. Gave's personal investment philosophy is simple and ruthless. Target 5 to 6% real returns with low volatility. He doesn't chase indices. He doesn't care what the S&P does. He builds portfolios that survive any environment. Now let's talk about the China energy story, because this is the part that should terrify every Western investor. China has been executing a multi-decade energy transformation while the West debated solar panel subsidies. The coal-to-gas conversion technology China deployed was originally developed by Germany during World War II, then exported to South Africa. China adopted it and scaled it to 1.5 million barrels of oil equivalent per day, a number that staggers even seasoned energy analysts. But the Thorium reactor story is in a different league entirely. China's largest industrial city now has free electricity from 8 a.m. to 8 p.m. Think about what that means for manufacturing competitiveness. Every factory in that city operates at near zero energy cost. Meanwhile, in Europe, industrial electricity costs have become existential. Gave's energy cost index puts Germany at 6, the US at 3, and China at 1. European manufacturers are not competing with China on wages anymore, they're losing on raw energy costs alone. France's nuclear collapse is a slow-motion catastrophe. Superphénix was the most advanced breeder reactor ever built. Shutting it down in 1999 under political pressure wasn't just an energy mistake, it was a civilizational one. A generation of nuclear expertise simply evaporated. EDF calling retirees back is the ultimate symbol of this failure. You don't build a nuclear industry by bringing back 70-year-olds. You build it by training engineers for 20 years. France skipped those 20 years. Now it's paying the price. Now let's get to gold, because Gave's argument here is one of the most elegant frameworks in modern macro investing. He doesn't think of gold as going up. He thinks of gold as the fixed point around which all currencies decline. His sell signal for gold is specific. The 10-year Treasury yield must be at or above GDP growth with a 200 basis point spread over short-term rates. In today's US, that means the 10-year hitting 5.5%. It's currently at 4.1%. Gold has nowhere to go but up. The $18,000 scenario isn't just speculation, it's arithmetic. The US holds 8,100 tons of gold. Foreign holders are sitting on $8 trillion in US debt. A gold revaluation to $18,000 per ounce would make those numbers balance. It's a managed default dressed up as monetary reform. On Western government bonds, Gave is unambiguous. France is running a primary deficit. It cannot even service its existing debt without borrowing more. VAT receipts down €10 billion. Storefronts shuttered in Paris's wealthiest district. This is not theory. This is happening now. Gave's historical research is blunt. No country has ever fixed its budget by raising taxes. Canada under Chrétien cut spending. Thatcher cut spending. Milei cut from 32 ministries to 7. The math is the same everywhere. Fiscal health requires spending cuts, not higher taxes. France has 34 ministries, over 1,000 advisory councils costing €30 billion a year. One council exists solely to fight noise pollution. This isn't government. This is a jobs program for bureaucrats funded by borrowed money that future generations will never be able to repay. The 60/40 portfolio worked for 40 years because inflation was falling and bonds were delivering real returns. That era ended in 2020. In inflationary environments with currency debasement, bonds don't balance equities, they amplify your losses. The math has completely changed. Chinese government bonds delivered 25% capital gains, while Western bonds lost 25%. That's a 50-point performance gap in 2 to 3 years. Gave is now looking at Brazil's 6% excess yields and Indonesia as the next convergence plays in Beijing's emerging Asian monetary zone. Let's talk about bonds, because Gave didn't just say to be cautious about them. He declared Western bond markets completely uninvestable. British bonds, French bonds, American bonds, all of them. That's a stunning statement from someone who's managed institutional money for 5 decades. France is running a primary deficit. That means it's borrowing money just to pay the interest on the debt it already owes before spending a single euro on schools, hospitals, or roads. It's like taking out a new credit card every month just to pay the minimum balance on the old one. VAT receipts in France are down 10 billion euros. That's the tax collected every time someone buys something. When VAT falls, it means consumers have stopped spending. The economy is quietly seizing up from the inside, and the government has no idea what to do about it. Avenue Victor Hugo, one of the wealthiest streets in Paris, in the 16th arrondissement, has every other storefront shuttered. When even the rich neighborhoods go dark, you know something is deeply wrong. This isn't a theory. Gave is watching it happen with his own eyes. Here's the uncomfortable historical truth. No country in recorded history has ever returned to fiscal balance by raising taxes. Not one. The only path that has ever worked is cutting spending. And governments across the West are doing the exact opposite right now. Gave points to three leaders who actually did it: Jean Chrétien in Canada, Margaret Thatcher in the UK, and right now, Javier Milei in Argentina. Milei slashed Argentina's government from 32 ministries down to just 7. 32 down to 7. That's not trimming the fat, that's removing the skeleton. France currently runs 34 ministries and over 1,000 advisory councils that cost 30 billion euros a year. 1,000 advisory councils. One of them, I'm not making this up, is called the Grand Council for the Fight Against Noise. That's your tax money, France. Now let's get to the investment philosophy that has made Gave one of the most respected macro thinkers alive. He doesn't chase indices. He never has. His target is 5 to 6% real returns with low volatility. That's it. Everything else is noise. The classic 60/40 portfolio, 60% stocks, 40% bonds, has been the default recommendation for decades. Your financial advisor probably still pushes it. But Gave says it only works in one specific economic environment, a disinflationary period, and that period just ended. From 1980 to 2020, 40 years of falling inflation gave 60/40 investors a golden run. Bonds rallied as rates dropped, stocks climbed. Both legs worked simultaneously. That era is over. We've entered an inflationary regime with currency debasement, and the bond leg of your portfolio is now working against you. Look at the 1970s. A classic 60/40 investor lost 40% of their capital in real terms over a full decade. Not in a crash, slowly, steadily, silently. Inflation and rising rates ate their bonds alive while stocks barely kept up. 10 years of work, wiped out by the wrong portfolio structure. But someone who held 60% stocks and 40% gold in the 1970s, they came out like a god. Gold absolutely exploded during that decade from $35 an ounce to over $800. The right inflation hedge didn't just protect you. It made you wealthy while everyone else bled out. Gave's updated portfolio framework for today's world. Replace the bond allocation with gold. Not because gold is exciting, it's not. It's boring by design. But in a world where every government is printing money and debasing their currency, gold is the only honest store of value left. Why gold? Here's Gave's elegant logic. 1 gram of gold is always worth 1 gram of gold. It doesn't go up or down, currencies go down around it. The price of gold in dollars, euros, or yen rising simply tells you that those currencies are losing purchasing power. Gold is the measuring stick, not the variable. Gave has been bullish on gold for roughly a decade. He's only got one condition that would change his mind. Real interest rates normalize. Specifically, when the 1-0-year Treasury yield sits at least 200 basis points above short-term rates and above GDP growth. That would mean a 1-0-year yield around 5.5%. The 1-0-year yield is currently at 4.1%. It would need to climb to 5.5% before Gave touches his gold position. But here's the brutal catch: if the 1-0-year actually reached 5.5%, the US federal budget would explode. The interest payments alone would consume the government. France too. It's a trap with no exit. Now here's the wildcard scenario that will make your jaw drop. The United States holds approximately 8,100 tons of gold in reserves. If the dollar collapses and foreign holders dump $8 trillion in US debt onto the market, Washington has a nuclear option: revalue gold. If Washington revalues gold from $4,000 an ounce to $18,000 an ounce, the entire $8 trillion in external debt gets covered, just like that. FDR did something similar in 1933 when he revalued gold from $20 to $35. The playbook exists. And the number Gave gives? $18,000. Let that number sit for a second. $18,000 per ounce. Gold is currently around $4,000. That's a 4.5x move from here. Now, Gave isn't saying this is the base case. He's saying it's the logical outcome of a full dollar collapse scenario. The math works out exactly. Stepping back from gold, let's talk about what's happening to the dollar's global dominance. For 70 years, the dollar has been the world's reserve currency. Every barrel of oil was priced in dollars. Every country needed dollar reserves to buy energy. That arrangement gave America extraordinary power, and now it's ending. The dollar's monopoly on oil trade is over. Countries can now purchase energy in their own currencies, renminbi, rupees, rubles. That means the $5 trillion sitting in foreign central bank reserves as emergency dollar holdings is becoming increasingly useless. Why hold dollars if you don't need them to buy oil? Trump's tariff strategy forcing Japanese and Korean automakers to relocate factories to American soil, using the AI boom narrative to lure capital back, is Washington's attempt to manage this unwinding. Gave acknowledges it could work, but he's not sugarcoating what comes next. It's going to be, in his words, extremely rough. Let's zoom out to the biggest geopolitical thesis in Gave's entire framework. He argues we're witnessing the most significant global power realignment in 500 years, 5 centuries. The shift from maritime empires Britain, then America, to a land-based power bloc centered on Moscow, Beijing, and Delhi. Maritime empires project power through navies. They control the sea lanes. They dictate who can trade with whom. The British Empire did it for 200 years. Then America took over. The entire post-World War II order was built on American naval supremacy. Now that model is being bypassed by land. When the West sanctioned Russia after Ukraine, everyone expected Russia to collapse economically. It didn't. Instead, Russia pivoted with stunning speed, building massive north-south infrastructure corridors connecting Siberian resources to India and Southeast Asia entirely by land. Pipelines, canals, roads, rail, all beyond the reach of any navy. For the first time in human history, all of Northern Asia's raw materials, oil, gas, coal, metals, grain, can reach Southern Asia without crossing a single ocean, without touching a single sea lane that the US Navy controls. The geographic choke points America relied on for leverage? Irrelevant now. The implications are staggering. India gets cheap Russian energy. China gets Siberian gas. Southeast Asia gets connected to the world's largest raw material base through overland routes that can't be blockaded. America's greatest strategic lever, control of sea trade, has just been structurally undermined. And now Gave's most explosive prediction. In 15 years, the financial capital of the world will be Hong Kong. Not New York, not London, Hong Kong. He says it with complete certainty. And when you understand China's dual currency architecture, his reasoning is frighteningly logical. Here's China's financial architecture most Westerners completely miss. China runs a dual currency system. The renminbi operates domestically controlled, stable, sovereign. The Hong Kong dollar operates internationally open, liquid, convertible. This gives China the best of both worlds, monetary control at home and financial openness abroad. Gave draws the parallel directly. What happened to Detroit's auto industry is about to happen to Wall Street. Detroit dominated global manufacturing. Then Asia built better cars cheaper. Detroit didn't see it coming until it was too late. Wall Street dominates global finance today. The pattern is repeating. What about Taiwan? Every geopolitical commentator seems convinced China will invade. Gave thinks this is completely wrong, and his reasoning is purely pragmatic. Taiwan is a geographic fortress. Cliffs on all sides except 3 narrow beaches. It sits 100 kilometers offshore. And China hasn't started a war in 500 years. China doesn't need to invade Taiwan. It's far cheaper and more effective to simply hire away TSMC's engineers. Offer them double the salary, relocate them to Shanghai, and rebuild the semiconductor capability there. Why risk a military catastrophe when you can buy the expertise with a checkbook? Let's talk about where the Asian boom is heading. Gave predicts a period of what economists call Ricardian growth, not new invention, but better utilization of what already exists. Better use of capital, labor, and existing technology. As Asia's infrastructure matures, the efficiency gains will be enormous and compound for decades. Meanwhile, in the West, the Magnificent Seven, Nvidia, Apple, Microsoft, Meta, Amazon, Tesla, Google have been the entire story. They've carried the S&P 500 to all-time highs while the rest of the economy quietly deteriorated. But Gave is direct. Those valuations cannot hold. The Magnificent Seven will deflate. Here's the math problem hiding in plain sight. If you own the cap-weighted S&P 500, you think you own 500 American companies. You don't. You're concentrated in 7 stocks that now represent roughly 30% of the entire index. Gave's words. You think you're buying diversification. You're not. The equal weight S&P 500 tells a very different story. When you strip out the mega-cap distortions and weight each company equally, the S&P Fossil Energy Subindex has actually outperformed by 2%. The underlying American economy outside the tech giants is holding up better than the headlines suggest. Now let's talk about where Gave is actually putting money to work. First stop. Chinese government bonds. This might sound crazy to a Western investor, but the data is undeniable. Chinese bonds went from yielding 5% down to 1.3%, delivering 25% capital gains in just 2 to 3 years. Compare that to Western bonds over the same period. While Chinese bonds delivered 25% gains, Western bonds lost 25%. That's a 50-point spread in returns in 2 to 3 years. If you were in Western bonds, you lost a quarter of your fixed income portfolio's real value. Full stop. Gave is now eyeing Brazil. Brazilian bonds offer roughly 6% excess yield, meaning they pay 6% more than what inflation and risk would normally justify. He also likes Indonesia, where he expects yields to converge toward Chinese rates as Beijing organizes an emerging Asian monetary zone centered on the renminbi. This is the Asian monetary zone thesis in one sentence. As China organizes regional trade and finance, neighboring countries' interest rates will gradually converge toward Chinese rates, delivering massive capital gains to anyone positioned in those bonds today. It's the European convergence trade of the 1990s, but bigger. Much bigger. Now for the stock picks, and this is where Gave gets genuinely surprising. He's bullish on Hong Kong bank stocks, not American banks, not European banks, Hong Kong. Because as the financial capital of Asia rises, the banks that dominate Hong Kong will benefit disproportionately from every deal, every IPO, every capital flow. His second surprise pick, French industrial companies. Not French government bonds, those are uninvestable. Not euro-denominated savings, those will get destroyed. But specifically the industrial giants, Schneider Electric, Air Liquide, Saint-Gobain. Companies that derive almost zero revenue from the French state. Why French industrials specifically? Here's the counterintuitive logic. France represents 26% of the European MSCI Industrial Index versus just 21% for Germany. The engineering talent is world-class. Schneider Electric is a global leader in energy management. Air Liquide dominates industrial gases worldwide. These companies make money everywhere except France. These are exactly the companies positioned to benefit from the Asian industrial boom. As China and Southeast Asia build out their energy infrastructure, electrification grids, and industrial base, they need the world's best energy management and industrial gas technology. French industrial giants provide exactly that. Let's be crystal clear about what Gave says to avoid. Euro-denominated cash. Avoid. French government bonds. Avoid. Any investment tied to the French or European state apparatus. Avoid. And most critically, do not park your retirement savings in euro-denominated life insurance contracts loaded with French sovereign debt. That's not saving. That's slow financial suicide. Gave has a particularly sharp line about this. He tells his French friends, "You believe France is going bankrupt, and then you buy French government bonds for a tiny tax break." He calls it the most self-defeating financial behavior he can imagine. The tax break is not worth betting your life savings on sovereign default. Let's zoom out to the macro picture one more time. The next 15 years will be defined by two competing forces: the deflation of Western tech valuations, particularly the Magnificent Seven, and the rise of Asian and global industrial stocks. These two forces will partially offset each other, but only if you're on the right side. The term Gave uses is Ricardian growth versus Schumpeterian growth. Schumpeterian is the exciting stuff, new inventions, creative destruction, the next great technological breakthrough. Ricardian is quieter but just as powerful, squeezing more value out of existing resources, labor, and capital. Asia is entering its Ricardian phase right now. Think about what Ricardian growth actually means in practice for Asia. China went from building its first high-speed rail line in 2008 to having more high-speed rail than the rest of the world combined today. That's not invention, the technology existed. That's optimization and deployment at a scale the West has never attempted. China's Politburo is full of engineers. That matters enormously. When China's leadership evaluates thorium reactors, high-speed rail, or coal-to-gas conversion, they understand the technology. They're not dependent on lobbyists or consultants to explain what's feasible. They can read the engineering specs themselves. That's a decisive competitive advantage. Compare that to France's nuclear situation. Superphénix, one of the world's most advanced fast breeder reactors, was shut down in 1999 by Prime Minister Jospin under pressure from the Green Party. A political decision, not a technical one. Since that shutdown, not a single graduating class of French engineers has chosen nuclear as a career path. EDF, France's state nuclear utility, is now reportedly calling retired engineers back out of retirement because there's literally nobody qualified to run the plants. This is what happens when politics overrides engineering for a generation. The institutional knowledge doesn't just slow down, it disappears. And it takes decades to rebuild. Meanwhile, China is commissioning thorium reactors. Thorium is the next generation of nuclear, safer, more efficient, and far harder to weaponize than uranium. China's largest industrial city now has essentially free electricity between 8 in the morning and 8 at night. 12 hours a day of free electricity for manufacturers. The energy cost comparison is devastating for Western competitiveness. If China's industrial energy index is at 1, America is at 3, and Germany is at 6. Germany pays 6 times more for industrial energy than China. That's not a minor disadvantage, that's a structural death sentence for German manufacturing over the next decade. This is why German industrial output has been declining. This is why BASF is scaling back European operations. This is why the auto industry, Volkswagen, BMW, is struggling. Energy is the foundation of manufacturing. When your energy costs 6 times more than your competitors, you cannot compete on price no matter how good your engineering is. The strategic implication is that the next wave of global industrial capacity, the factories, the supply chains, the manufacturing hubs, will be built in Asia, not Europe. Not because European workers are lazy or European engineers aren't talented. Because the energy economics make it mathematically impossible to compete. Let's bring this back to the investor sitting in front of this video right now. What does all of this actually mean for your portfolio? Gave's framework gives us a clear decision tree. Your assets fall into one of 3 buckets. Things that win in this environment, things that survive it, and things that get destroyed by it. In the win bucket, gold for currency debasement protection. Hong Kong bank stocks for the Asian financial boom. Selected Asian government bonds, China, Brazil, Indonesia for capital gains as rates converge. And French industrial giants for the global energy transition build-out. These are Gave's core long positions. In the destroyed bucket, French government bonds. Euro-denominated cash sitting in savings accounts. Euro life insurance contracts stuffed with sovereign debt. Any instrument that depends on Western governments maintaining fiscal discipline, because that discipline, Gave argues, is gone and isn't coming back. One of Gave's sharpest observations is about how slowly these tectonic shifts happen and how violently they accelerate at the end. The dollar's reserve currency status took 40 years to build after Bretton Woods in 1944. Its unwinding has been happening for 15 years already. But the final phase, when it breaks, will happen fast. This is the Hemingway principle applied to finance. How did you go broke? Gradually, then suddenly. The gradual phase gives everyone false confidence. The gradually then suddenly pattern has played out in every empire transition in history. Ottoman, British, Soviet. The warning signs are always visible in retrospect, rarely in the moment. Gave is not predicting the end of America. He's predicting the end of American financial supremacy, the ability to print the world's reserve currency, run unlimited deficits, and export inflation to everyone else. That privilege, which has funded America's global power for 80 years, is ending. What replaces it is a multipolar financial world. In a multipolar financial world, no single country runs the game. Capital flows to wherever returns are real. Bonds get priced on actual creditworthiness, not on the assumption that America will always backstop everything. Gold re-emerges as the neutral reserve asset because it has no political allegiance and no counterparty risk. There's a personal finance lesson buried in all of this that goes beyond asset allocation. Gave has been managing money since the 1970s. He survived the inflationary decade, the 1987 crash, the dot-com bust, the 2008 financial crisis, the COVID collapse. His survival secret? He never takes large, concentrated bets. He targets consistent, real returns. The biggest mistake most retail investors make is letting fear and greed override their framework. When markets are up, they chase returns. When markets crash, they sell everything. Gave's discipline is to ignore both impulses entirely. Build the framework. Trust the framework. Let the math work over time. Boring wins. For a young investor starting today, Gave's message is actually optimistic. Yes, the Western financial order is under stress. Yes, bonds are bad. Yes, the dollar faces long-term pressure. But history is full of transitions, and transitions create the greatest investment opportunities of any generation. You just need to be on the right side. Think about the investors who positioned correctly at the last great transition. People who bought Japanese stocks in the 1950s. People who bet on American tech in the 1980s. People who loaded up on emerging market bonds in the 1990s. Each one of those was obvious in retrospect and invisible to the majority in the moment. This is that moment. One thing that makes Gave uniquely credible is that he corrects himself publicly. He admits the MSCI World Energy Trade underperformed his expectations. He doesn't hide from it. He explains why the distortion of the cap-weighted index made the trade look worse than it was in the underlying stocks. Intellectual honesty is rare in finance. The intellectual framework underpinning all of Gave's analysis is classical economics, Ricardo, not Keynes. He believes in price signals, comparative advantage, and the inevitability of capital flowing where returns are real. When governments distort those signals for too long, the eventual correction is violent and unavoidable. The West has been distorting for 40 years. Let's tie together the full picture. Energy advantages plus engineering talent plus land-based trade infrastructure plus a dual-currency financial platform. That's China's hand in the next 20 years. Gave's assessment is not anti-American, it's purely analytical. He goes where the math leads, and the math leads east. America's hand is not empty. It has the world's most innovative private sector, the deepest capital markets, the best research universities, and the dollar still accounts for 58% of global reserves. The question isn't whether America has strengths, it's whether those strengths are enough to maintain financial supremacy as Asia rises. Gave's answer? Probably not. Not because America fails, but because Asia succeeds at a speed and scale that changes the relative equation. When the pie of global wealth expands dramatically in Asia, America's share shrinks even if its absolute level is unchanged. Relative decline is still decline for those holding dollar-denominated assets. Here's what this all means at the personal level. If your entire financial life is denominated in dollars or euros, your savings, your retirement account, your bond allocation, your cash, you have a massive concentrated bet on Western monetary stability. Most people don't realize this. Diversification across currencies is not optional anymore. It's essential. Gave's final message carries a philosophical weight that goes beyond finance. He quotes his opening line with full sincerity. Life is short. Never accept an attack on your freedom. Never accept being bored. He means it as investment advice as much as life advice. Don't be trapped in a system that's dying out of inertia or habit. If there's one sentence summary of Charles Gave's entire framework, it's this. Follow real returns, avoid fiscal fantasies, and position where the energy and the engineering talent actually are. Everything else, the politics, the narratives, the TV commentary is noise designed to keep you distracted from the math. Let's do a quick final scorecard. What Gave is bullish on: gold, Hong Kong bank stocks, Asian government bonds, particularly China, Brazil, and Indonesia, French industrial multinationals, and energy companies in the equal weight index. Each of these benefits from the structural trends he's identified: currency debasement, Asian growth, energy transformation. What Gave is bearish on: British, French, and American government bonds, euro-denominated savings and life insurance, cap-weighted S&P 500 due to Magnificent 7 overconcentration, European utilities dependent on expensive energy, the French and European state more broadly. These are the fiscal fantasies he says are slowly imploding. The asset reallocation this implies is significant. If you're currently holding 40% bonds as per the classic 60/40 rule, Gave would argue at least half of that should be in gold and the rest in high-yielding Asian and emerging market bonds. Your equity allocation should tilt from US mega-cap tech toward global industrials and Asian financials. None of this has to happen overnight. Gave himself operates with low volatility and consistent returns over time. Small consistent tilts in your portfolio compound dramatically over 15 years. Moving 5% of your holdings into gold today, adding Asian bond exposure gradually, reducing US mega-cap concentration slowly, these are manageable moves with potentially enormous payoff. The most important takeaway from spending time with Charles Gave's thinking is this: the people who get destroyed in major economic transitions aren't the ones who made the wrong bet. They're the ones who made no bet at all, who stayed in the default, assumed the status quo would continue, and woke up one day